Oh, and by the way, with non-tax deductible dollars. And this is the most egregious part in terms of tax efficiency. Imagine you're an accounting firm. I want to use accounting as an example because even the accounting firms don't understand tax deductions. And that 90% of the money, 70, 80%, maybe whatever, the majority of the money, vast majority, is the partner's money, the owners. If most of the money is the owner's money, that means they're paying most of the fees because the fees are always passed on, not equally, although you could potentially do that, but it never happens that way. But they're passed on in proportion to the account balances, again, with non-tax deductible dollars. And you can't see them, so you're not going to be cost sensitive, as Milton Friedman described in his 4 ways to spend money. You can spend your own money on yourself, your own money on someone else's money on yourself, or someone else's money on someone else. And the latter is where you don't economize and you don't seek the highest value. In other words, you just don't care because you have no reason to be sensitive to the cost. But if you're paying at the employer level, it's all the partner's money anyway, and you get a tax deduction like you would for any other business expense, and you are paying for all of it out of your accounts anyway. You might as well pay at the employer level because not only will you be more sensitive to the fees, but nobody else will have to pay anything. And if financial advisors are touting these accounts, which they always do, as tax advantaged accounts that you should have as much money in as possible inside of, then why on earth would you then try to extract the maximum amount of money outside of in an account that you just said to stuff all your money into? It doesn't really make any sense. And of course, you could use this as a recruiting tool versus other small firms who don't even know that they could pay these fees at the employer level. The Department of Labor did a study showing an example of a participant who's 35 years old that has a $25,000 balance. And over the course of the investing lifetime, 30 years until retirement at age 65, an extra 1% in fees, just an extra 1%, and oftentimes it's worse for that participant, and oftentimes it's worse when you have more money, or would be, that participant would pay 28% in additional fees, and in dollars, approximately $67,000 as a result of that additional 1% in fees. And if you explain that to a potential recruit, you're basically allowing them to receive significant additional compensation that other small firms that don't know to pay at the employer level would not be offering.